And coming into this year, the dominant narrative was that these trade tariffs imposed by the White House was going to have a negative impact on the EU economy, especially if it was going to be targeting Europe, and that would send the euro lower. But now, this US growth scare seems to be outweighing. It's dragging the dollar down, and on the flip side, the European spending proposals are boosting European growth prospects and yields, like you said. And this has really helped prop up the euro. It's back to the strongest level since before the US election.
This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance.
Hello and welcome back to the Converge market update for the 12th of March and into the first 50 days of President Trump's second term. It's brought heightened volatility to financial markets, with investors worried about a budding global trade war and slowing economic growth in the world's largest economy. We've witnessed an extended sell-off in equities as a result, which are primed for the worst start to a presidential term since 2009. The US dollar's dominance is fading, while the euro and other European currencies are on the front foot for once. We've got George Vessey, our lead FX Macro Strategist, back with us today to unpack the latest twists and turns of the tariff narrative and what could be a significant turning point for Europe in particular. So, at a high level first, George, what are the main themes dominating global markets at the moment?
Hey, Steve. Good to be back. It seems like every episode we're saying there's lots going on, lots to unpack, how significant certain events are, but it really just highlights how unique and the current macro and political landscape really is at the moment. But last week was particularly historic. We had two big themes dominating global markets. The first one was the continued confusion surrounding Trump's tariffs, and the second one was the potential new German coalition announcing a historic stimulus package to prop up its infrastructure and military. Both of these, they've worked against the dollar, which had its worst week since 2022 last week, whilst the euro, on the flip side, had its best week since 2009, rising about 4.5% against the dollar.
Yeah, some absolute monster moves across markets over the last week, that's for sure. Let's dig into some of those themes that you mentioned a bit more. And first of all, of course, tariffs. The Trump bump has turned into a Trump slump, right? Uncertainty remains high. Recession fears are rising. What's going on?
Yeah, exactly. If we think back to our US election guide that we launched before the US election in September, well, we indicated then that the dollar and equity markets would likely get a boost from a Trump win on the hopes of tax cuts and deregulation. But we also warned about the repercussions of tariffs. And it does seem that Trump's execution of tariff policy is really starting to take its toll on businesses, consumers and investors alike. And this so-called tariffs on, tariffs off theme, whereby Trump keeps flip-flopping with these tariff threats and causes so much confusion and uncertainty, is really taking its toll. Last week, for example, Trump once again reversed course by delaying tariffs on Canadian and Mexican goods for another month. So that marked the second consecutive month-long delay, which, again, to repeat, is reinforcing this uncertainty in trade policy. And even over the last 24 hours, we've heard Trump threaten to double steel tariffs and aluminium tariffs on Canada to 50%, before once again reversing course. But what's different now compared to that first delay that we had at the start of the year is how markets have reacted to it. So investors haven't really cheered the news like they did last time. They're no longer reacting positively to these short-term postponements, because in reality that they want some clarity. They don't like this unpredictability. And in fact, yesterday we had some data out from the NFIB, the Small Business Optimism Index, and that fell to its weakest level since October last year. But the main point of this is that the uncertainty index amongst this, the sub-index amongst businesses, that surged, the uncertainty index surged to a near record high. So, this all plays into the theme of recession too, because all of this is fueling the narrative of a slowing US economy. And also, we've got to bear in mind that the latest data on the full tariff rollout as well is potentially going to disproportionately hit lower income earners in the US too. So this just adds another layer of concern to an already fading or fragile economic backdrop.
Yeah, I love that fact about the NFIB Small Business Optimism Index falling sharply because, of course, after the Trump election win, it had one of its biggest one-week gains that we'd seen. So businesses really finding it hard to manage or predict the uncertainty in their businesses and in markets. But it seems like, again, thinking about just after the election, the focus about tariffs was all about the inflationary impact of tariffs. But now it's moved more to a US growth scare. What's the evidence coming through in the data telling us about what's happening there?
This fear isn't just appearing out of thin air, of course. We've already seen that the US economic backdrop has worsened this year. We've had some data misses and import front loading, and that's led to the Atlanta Fed's GDP nowcast model into negative territory. So that's estimating that the economy, the US economy, is going to shrink at a 2.8% annualized rate in the first quarter of this year. So a monster move there in that model of GDP growth for the US. The services sector, that's still holding up though. We had the last ISM report released last week, and that was reasonably strong, so it lessened recession risks a bit. But jobs growth, the manufacturing sector, there may be starting to turn south again. Of course, it's hard to tell from one data point at a time, but it's clearly something to watch as we go into the further data for coming out this month. And despite all of this, like the slowing of economic activity, inflation is still a concern. We have the PCE inflation index from a couple of weeks ago that met expectations by rising a bit. But we did see that personal spending decline. It was the first drop in nearly 2 years. Over the next couple of days, we've got consumer and producer inflation data coming up, and that's expected to have picked up from the previous month as well. So it's a bit of a conundrum for the Fed, of course, because in terms of its monetary policy decision making, because of this slowing economic activity and rising inflationary fears. But markets are now pricing in over 3 more rate cuts for the remainder of this year, versus what was just a one cut pricing just a few weeks back.
Interesting. So US recession risks are on the rise. Investors are nervous. But what about what's going on in Europe? Like you said earlier, the euro had its best week since 2009 last week, rising 4% against the US dollar. It's normally a more pro-cyclical currency, so you'd expect it to weaken on global growth concerns. But as you said, the other main theme in focus is the historic spending plans we're hearing out of Europe. Is this a watershed moment for Europe and the euro?
Yeah, I think so, Steve. If we think there's this running joke for the past 15 years that European economics has been about waiting for Germany to spend some money, and that is true. Germany has lacked investment for years, and against the backdrop of an aging population, a shrinking workforce, it means that higher productivity is essential. And until last week, the outlook did still remain bleak. But now, as part of their grand coalition negotiations, the likely new government outlined a 500 billion euro infrastructure fund. And that could be one of the largest fiscal expansions in Germany's post-war history, potentially widening deficit to 4% of GDP over the next decade. The details do remain unclear at the moment, and still needs to be implemented and agreed on. But basically, at a high level, that these plans aim to bolster military deterrence, drive economic recovery, and reshape Germany's lagging infrastructure. But what makes this even more historic, this shift, is that reforming the debt brake is far from a popular idea in Germany. So pushing this through really would be a seismic event for Europe, and the markets have reacted positively as a result.
Yeah, absolutely. Seems like a seismic event, and also, I think, mostly unpredictable in terms of the domino effect of how Trump's policy on foreign policy has played out to see the euro so much stronger around these themes. Now we're seeing European stocks massively outperforming US stocks. We saw Germany's 10-year government bond surge by an incredible 30 basis points in one day. It's the largest single increase in financing costs since the 1990s. But talk to me about FX, because that Euro USD parity call, is it dead in the water now? Surely.
Yeah, surely. I mean, we did get close to it, I guess. That 101 level that we hit in January, and coming into this year, the dominant narrative was that these trade tariffs imposed by the White House was going to have a negative impact on the EU economy, especially if it was going to be targeting Europe, and that would send the euro lower. But now, this US growth scare seems to be outweighing. It's dragging the dollar down. And on the flip side, the European spending proposals are boosting European growth prospects and yields, like you said. And this has really helped prop up the euro. It's back to the strongest level since before the US election. And in fact, with its 5.3% gain so far this year against the dollar, the euro is close to erasing all of its 2024 losses of 6.2% that we saw. So to reiterate, the euro is drawn on almost every typical driver to lift it higher, with the net effect outweighing that drag from souring global risk sentiment, as you mentioned, that would usually pull it lower. However, the short-term outlook, yes, it is constructive for the euro, but there's two factors worth keeping in mind. One of which is that the euro dollar has strengthened some 5% this month alone. So, the easy gains are already behind it. And two, just the extent of the rally, the recent surge that we've seen means that the currency pair is in overbought territory now. So it might need to consolidate around the current levels before heading any higher. But beyond those hurdles, there's little reason to think that euro dollar can't reclaim the levels of around 111 that prevailed before the market started front loading that idea, or front running that idea of the Trump trade back in late September, and especially if this whole US exceptionalism narrative keeps fading away and dragging the dollar down.
Yeah, incredible. Almost 10 big figures in the Euro USD in 2 months. An incredible rebound in that currency pair. What about elsewhere? How are other currencies reacting in this increasingly more uncertain geopolitical landscape?
We've seen some textbook risk-off trading. We've had some, seen like the safe havens, like the Japanese yen gaining ground against those riskier high beta and commodity currencies. The Aussie dollar against the Japanese yen rate, for example, is a key barometer of FX risk. It was down up to 1% this week. And as thankfully for the Aussies gained some ground back. But this year it is down at 4%, so it's tracking the fall in equity markets that we've seen. Against the US dollar, the Aussie is still finding it hard to break through that technical resistance barrier of 0.64. But still finding support around that 0.62. So we're kind of waiting for a convincing break of either to determine the next trend. But given the weaker US dollar narrative at the moment, maybe the path of least resistance could well prove to be to the upside. And then here in the UK, Steve, obviously I'm monitoring the pound closely, and what we've clearly seen is a twofold story unraveling, whereby the pound is strengthening against the US dollar, like everything else is, and a weakening against the euro, like everything else is. So sterling dollar's up almost 3% this month as a result of the narrowing growth differentials between the US and UK, and the improving interest rate differential with the US because of these more Fed rate cuts being priced in. And as a result, all eyes are on the psychologically important 130 handle for this currency pair, having broken above some key moving averages over the past couple of weeks. Whereas against the euro, due to the euro's resilience, its strength over the past week or so, the pound suffered its worst week in 2 years last week. So it slid almost 2% from 121, and it's now testing a key support just under the 119 level. Again, it just represents this huge seismic shift in sentiment in favour of the common currencies we've spoken about. So yeah, it looks like the pound may have hit its top against the euro this year, but more gains could be in store against the buck.
Nice. Great stuff, George. Thanks for the insight. Lots to unpack and lots of uncertainty. Perhaps the easiest call at this juncture is that conditions will remain volatile as a result. We'll check back here in a couple of weeks as always, but thanks again for joining us, George.
Thanks for having me, Steve. Catch you next time.